Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're covering 5 year-end financial moves to consider. This is something that we did a couple of years ago that I thought was particularly helpful, but the difference is that a couple of years ago, the 5 moves that we covered were directly related to a pending piece of tax legislation. This year, we're covering 5 moves that make sense to consider regardless of any pending legislation or other stuff that's coming up right now. So the 5 moves we'll cover, we have reviewed them on the podcast in the past, but they are a good reminder for everybody to consider what opportunities you might have before the calendar clicks over to 2024, because as you know, that's when the new tax year begins, and this is our last opportunity to move the needle for 2023. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. All right, everybody. So this week on the podcast, I would like to cover 5 financial moves that you might want to consider making by the end of the year. This is a topic, this is something that we went over a couple years ago. So if some of this sounds redundant to you, I apologize. The episode that we cut a couple years ago on this topic was actually related to a pending tax bill and stuff that was about to change in the tax code. This year, we're just going to cover 5 things that you might want to consider consider doing financially by the end of the year, because even if you know these things already, it's a really, really good reminder, because from a financial perspective, from a tax perspective, the calendar is about to turn over, right? We start a new year fresh from a tax perspective on January 1st. That makes 2023, this last week or two that we have in 2023, your window of opportunity for doing this stuff is rapidly closing. So I'm going to cover 5 things that you might want to consider. As always, you can kind of pick and choose from these 5 items to deploy in your own financial planning and for your own financial plan. Some of them might be a good fit for you. Some of them might not be. Some of them might not be relevant to you at all. But I'll cover 5 relatively basic things and inject maybe a few recent case studies we've had with clients going over these 5 concepts in a way that was really, really beneficial to them. And the first one that comes to mind that you might all be thinking is gifting. Some kind of charitable gifting. If you're someone who's charitably inclined and wants to donate cash or some kind of asset to charity, now is the time to do it. As a reminder, and a lot of you probably already know this already, but just as a reminder, you have to itemize your deductions in order to benefit from a charitable gift. So everybody is afforded the standard deduction that the IRS gives you when you file your taxes. If your itemized deductions total an amount that's greater than that standard deduction, which this year for individuals is a little less than $13,000, if your total itemized deductions exceed that amount, $13,000 or so, then you list all your deductions out on Schedule A, you itemize them, and you get to reduce your income by whatever that total amount is. So if you're someone that has some state and local taxes that you pay, maybe $3,000 or $4,000, and mortgage interest of $3,000 or $4,000, and your total itemized deductions are $8,000, well, if you give $500 to charity, that's great. It's a wonderful thing to do, but you're still going to be taking the standard deduction because your total itemized deductions would only be $8,500, $4,000 plus $4,000 plus $500. That's still less than the standard deduction of $12,700 or $13,000, whatever it is this year. So I say that because giving to charity is always a wonderful thing. whether you're giving to the American Red Cross or the American Cancer Society or something local and smaller, local to you or to your church, whatever it is, if it's a bona fide 501c3, you get to deduct it, the contribution on your tax return as long as you itemize. Now, there are a couple other things I wanted to elaborate with this one, elaborate on with this one. One of them is that some of you might be thinking, yeah, I like to give to charity, but I've already paid my tithes to the church. I've already given my annual amount that I like to give, and I'll just wait until next year. Well, there is, as always, some gamesmanship to be had here, because you can always make several years worth of donations into a charitable account that you control, and then dole those subsequent distributions out to charity in later years. And so here's an example we're going through with a client right now. They have they just retired. They were a high-powered executive. They have a whole lot of income this year, like 7 figures of income. And so they have been giving to a local charity consistently for a long time. And what they want to do is create what's called a donor advised fund in their name and make a donation of several years worth of contributions to this organization right now. And the benefit of that is with the donor advised fund, which we talked a little bit about on the podcast in the past, is you put assets into this new account. That's when you get the tax deduction. So you're able to front load your charitable giving and take a substantial deduction this year, which coincidentally for this person is the year, probably the highest income year she's ever going to have for the rest of her life, because she's now retired, and will benefit more from the deduction this year than she will from a deduction down the road. So you make a big contribution. Let's say that you want to give $10,000 a year to a local charity, but this year you just have a heck of a lot more income than you usually do. You could contribute $50,000 to a donor advised fund and get a deduction this year for $50,000. And then next year, you have the custodian of your donor advised fund account cut a check to your charity for $10,000. The other $40,000 stays in the account. That's not a taxable event because you've already claimed the deduction. You're just doling out the account after having claimed the deduction and doling it out to your charity of choice, that is. So that's a really powerful option. And what's even better than that is you don't have to gift cash. This person, for example, had a bunch of highly appreciated shares of stock that they had picked up of the corporation where they used to work over the course of their career. And so if they had, let's say the stock was trading at $100 a share, but they had picked it up when it was $10 a share from 15 or 20 years earlier, well, if they sold it, they'd have a big taxable capital gain on their hands. And then they'd have to pay tax on that and then fork whatever is left over to the charity and get a deduction on that amount. Well, the cool thing about this donor advised fund option or giving to charity directly is you can just directly gift the shares of stock without selling them. And in this circumstance, they were giving a couple $100,000 worth of stock to a donor advised fund account. You claim the deduction based on the value of the stock without selling it. The stock hits the account. Remember, it's a charitable account. This is an irrevocable donation. You don't get the money back. But once the shares are in the account, they're sold. There's no tax impact on that. And then from that point forward, you can give to your charity of choice in allotments as you see fit from that point forward. So not only was this person able to front load a whole bunch of deductions, but they were able to gift highly appreciated stock and save tax on that too. So those are just a couple things to think about as it relates to your charitable giving. If you're somebody who wants to fire this up, this donor advised fund that I'm describing, you're going to have to hustle to get it in by the end of the year. Thinking through it now, we may have wanted to publish this episode a couple weeks earlier because it does take a little bit of time to get these things set up and funded. That being said, giving to charity is always a noble thing to do. Now, the final thought I have on gifting is from an estate perspective. If you're someone who lives in a state with an estate tax, like Oregon or Washington or several others, then you might be aware of the fact that after you die, in Oregon, for example, if your estate is worth more than $1 million, there will be an estate tax imposed. And one really cool strategy to mitigate that is to gift assets to your beneficiaries while you're still alive. And you can give up to a certain amount every single year without any gift tax repercussions. This is one that I should know off the top of my head, but I don't. Last year, the threshold was $16,000. In 2023, I can't remember whether it's $16,000 or $17,000. But the point being, if you're someone who's going to give everything to your kids after you die, and you live in a state that's going to tax anything that's left over, well, if you don't need it yourself, you might think about gifting it, starting to gift it before the state comes in and levies a tax on it. So you can give up to $16,000 per year. It might be just slightly higher than that in 2023, but that's something to consider by the end of the year as well. Now, number 2 on the list has to do with cash. We've talked a lot about how to handle cash in business settings, a framework for paying yourself out of your business, whether you have a pass-through entity like an LLC or an S corporation, sole proprietorship, or perhaps not, like a C corporation. But if you're in this situation where you own and operate a business, you have decisions to make with regard to handling cash, and now is the time when you want to review that. Just to remind everybody, to refresh everybody's memory, if you have a pass-through business like an S corp, like an LLC, or a partnership, or a sole proprietorship, your taxation is not going to matter whether cash sits in the business account or you take it out and put it in your personal account at the end of the year. But what does matter is how much you're paying yourself in W-2 wage. For example, owners of S corporations, you can deduct your medical insurance premiums, but you have to what's called reimburse yourself through W-2 payroll. And so number 2 on the list is if you're a business owner operator, you have decisions to make, and it is important to sit down with your tax person before the end of the year and just go over everything together and make sure you're not missing opportunities. Because I can tell you, having done this for a while, there are always opportunities to optimize and maximize around the margins, and just be aware of what the landscape is before you close the books on the year and go home for the holiday season if you're taking time off. Now, number 3 is Roth Conversions. This is another one that we've talked about quite a bit on the podcast. And again, I'll apologize for anybody who thinks this is redundant. I keep bringing this strategy up on the show because it is really, really powerful long term. If you have assets in a tax-deferred retirement account, whether it be a 401k plan at work that might allow you to convert assets to a Roth account within the plan, or in a traditional IRA, you can take assets in that account, move them into a Roth IRA. It's not considered a contribution that's subject to the annual limit of $6,500 this year. This is considered a conversion. There is no limit on the amount of assets that you convert from a traditional IRA or 401k to a Roth IRA or 401k. Every penny that moves over is going to be, considered taxable income, unless you have a basis in it, which is a topic for another day. But if you take $10,000 from your traditional IRA, in almost all circumstances, if you move that to a Roth IRA and convert it, you'll have an additional $10,000 of income. This is something that we go over, we review for almost all our clients every single year, because the gamesmanship here and the opportunity is that if you're in a tax bracket this year that's lower than you expect to be in down the road, either next year and from then on, or maybe down the road when you're in retirement, 5, 10, 20, 30 years away, it might be a good idea to convert the assets to a Roth now. Because when you have them in the traditional account, the IRA, the 401k, remember that the IRS is going to force those assets out of the account when you're older, in your 70s. You don't have discretion over that. They are waiting to tax you on that money. And so they impose these mandatory distributions. Now, the rules can change between now and when you're personally in your mid-70s. But right now, put assets away in your 401k plan at work. You defer taxation on that. When you're in your mid-70s, they force you to pull it out. And what we see over and over and over again is people who are good, dutiful savers in their own retirement accounts have a whole bunch of tax-deferred money stored up. And when these mandatory distributions come around, the amount that they have to take out, remember, it's all taxable income, actually forces them into higher tax brackets. And so the opportunity here is shovel some of those assets into Roth accounts in the years when you're in lower brackets. The downside of doing this is that you're incurring taxation in a year when you don't otherwise have to pay it. And a lot of tax practitioners will tell you that just in general, they like to just kick the can down the road and pay as little in tax on a year-to-year basis as they possibly can. But the fact of the matter is that if you quantify how much you'll pay in tax by leaving those assets in your traditional IRA, traditional 401k, versus converting some of it and moving it into a Roth IRA and paying a lower amount of tax earlier on, as opposed to a greater amount of tax later, if you live for a substantial amount of time, if you're going to live into your mid-80s or 90s, this will save you a whole lot of lifetime taxation. So here's the to-do, is you forecast your taxes for the year. Where do you think you're going to fall? What bracket are you going to be in? And how much room is there between your taxable income for the year and the top of whatever tax bracket you're in? And the way we typically see this play out is somebody might come in and have taxable income that's, let's say, they're married filing jointly, and it's their income is $65,000 less than the top of the 24% tax bracket, or beginning of the 32% tax bracket. So remember that the way that these tax tables work, the more income you make, the higher rate of tax you pay on it. And our brackets go from 10% to 12% to 22 to 24 to 32 to 35 to 37. And for whatever reason, a lot of people just tend to fall in the mid-range of that 24% bracket. And it's a fairly substantial jump between 24% and the next one up, which is 32%. It's an 8% difference in taxation. So if your taxable income is $65,000 below the beginning of that 32% bracket, well, guess what? Your opportunity is to Roth convert $65,000 of your tax-deferred assets. And again, the benefit is it's very likely that if you live a long life, you're going to pay a lot less in aggregate taxation by doing that. The downside is that you're paying it earlier than you otherwise have to. And if you kick the bucket a year after proceeding with one of these conversions, you're not going to be able to realize the benefit. It will be the beneficiaries of the accountant who do. So that's number three. The first year-end opportunity we looked at, gifting to charities, donor-advised fund, and then to charities, or perhaps to your beneficiaries directly for estate tax minimization purposes. The second one, cash distributions. Take a look at your cash plan, meet with your tax provider, meet with your financial person, have an understanding of how your business operations are going to impact your tax picture. And then number three, consider Roth conversions depending on what tax bracket you fall in. If this is a year where you have a whole bunch more income and you're in a higher tax bracket than you will be in the future, it's not the year for Roth conversions. It's the year for contributions to traditional tax-deferred accounts, because you want to defer taxation when you have more income and are in higher brackets, and you want to trigger taxation when you have less income and are in lower brackets. Trying to pay less tax on the whole thing. That's the whole name of the game. Now, Number 3 has to do with investments in taxable investment accounts, and that's harvest losses in your taxable investment accounts. This one is not going to apply to you if you only have if your investments are sitting in tax qualified retirement accounts like 401ks, IRAs, Roth accounts, cash balance plans, pension plans, anything that we've that is associated with some kind of tax benefit. This doesn't apply to. But if you have money in taxable investment accounts, either in your name or in the name of a trust or jointly held with a spouse or something like that, this might be an opportunity. And when you have an investment in these accounts, as you probably know, if that investment pays a dividend, or maybe it's a mutual fund or an ETF and it has a capital gains distribution or something like that, you get to pay tax on that distribution. So when you hold the investments, the value is going to change over time. If you buy a stock at $50 a share and then it goes up to $100 a share, you have an unrealized gain of $50 a share. You don't pay tax on that until you realize it and sell the position. So once you sell it, that triggers $50 per share in capital gains that you have to pay tax on. But as you know, not all your investments always go up. Some of them go up, some of them go down, sometimes temporarily, sometimes for a long period of time. There are a whole lot of variables here. And so if you buy something at $100 a share and then it falls in value to $50 a share, that's an opportunity, because you could sell the stock at a tax loss and harvest a $50 per share loss. And this benefits you in a couple of different ways. Number one, let's say that it's one share of stock and it's down 50%, and you harvest that loss by selling the share of stock. Well, if it's 1,000 shares of stock, multiply that by 1,000. Then you have a $50,000 loss on your hands. And as much as that might sting to see the value of your investment go down like that, harvesting them from a tax perspective is actually pretty beneficial. So let's say that's your situation. You have $50,000 of losses. You harvest them. When you file your taxes for the year, you get to use $3,000 of those losses against your income. So let's say you have these $50,000 of capital losses and you make $100,000 this year. Well, of the $50,000 of losses, you get to use $3,000 of that to offset the $100,000 of income, which means that you're only paying tax on $97,000 instead of $100,000. The other benefit here is that the $47,000 of losses that you don't use, they don't evaporate, they don't go away, they just roll forward into the next year. And so next year, if you don't have any capital gains to offset them with, you have $47,000 of losses in the bank, quote unquote. You get to use another $3,000 against your income next year and keep working down the balance until you run out of net losses. Now, let's take this a step further. Let's say that you have the $50,000 of losses, but then you get into, crypto trading and you do really well and you make $25,000 of realized gains trading in a different account by the end of the year. Well, losses and gains are always netted against each other from a tax perspective. So it's not like you have $50,000 of losses, you use $3,000 of them to offset your income, and then you pay tax on the $25,000 of gains. The way this works is you net your long-term gains and losses against each other, and I'll explain that in just a minute. And then you net your short-term gains and losses against each other, and then you net the net amount of the short-term gains and losses and the long-term gains and losses. And whatever is left over is the number that could potentially carry forward to the next year. So if you've got $50,000 of losses and then $25,000 of gains, you now have $25,000 of losses. You use $3,000 against that, against your 100 grand of income. And now you have a loss carrying forward to the following year of $22,000. So here's the to-do for number 4 is review the statement, the position and unrealized gains and losses in any taxable investment accounts that you have. And if there are some that have losses that haven't been realized yet, you might want to consider selling the position. That's not a comment on whether or not you think it's a good investment to be in and whether you want to hold that long term in your portfolio. It's just a generally good practice to harvest these tax losses and put them in the bank for future use so that you can when you have capital gains in the future, you have a loss carry forward sitting there that you can use to offset it with and not pay tax on that future gain. So a couple things to clarify. Number one is there's this wash sale rule. And what that means is you can't sell the position, let's say the position at the $50,000 loss. You might say, yeah, this sounds great, but I really like that company. I really like that investment. I don't want to get rid of it. I want it to be a core part of my portfolio. In that event, you sell it and then you can buy it back sometime later. What you can't do is sell it and then buy it back 3 seconds later and expect to harvest the loss because you weren't materially out of the position for long enough. This is called the wash sale rule. And you can buy it right back. There's nothing against there's no rule against that. You're free to buy and sell whatever you want at will. It's just the case that you're not going to be able to use that loss until you've been out of the position for at least 31 days. So you have to be out of the position for a month. After that month has elapsed, you can buy back the position and then keep your portfolio like you want, yet still harvesting that loss for tax purposes. Now, the other thing to be aware of is the difference between short and long-term gains and losses. Short-term gains are classified as gains and losses on anything that you've held for 1 year or less, 365 days or less. As soon as you hold an investment for 366 days, long-term capital gains treatment is applied. And so if you're someone who's trying to pick through which gains to harvest, and we'll cover that in a moment as well, you want to think about this strategically, because if you have net capital gains, short-term gains are taxed at your ordinary rate of income. And remember those tax brackets we were just talking about, 12%, 22%, 24, 32, 35, 37. Long-term capital gains are taxed at lower rates. So if you're sitting on a gain and you're thinking about getting out of a position and you've held it for almost a year, well, you might want to think about making sure you hold it until day 366, because as soon as you do, lower tax rates will apply on those gains. Now, the last thing that I wanted to cover here is harvesting tax gains. Or excuse me, tax gains. We just talked about losses. So there's a really good argument for harvesting tax losses in any taxable account at the end of the year or throughout the year as the opportunity comes up. Because even if you don't want to exit a position, and another alternative to that, by the way, an alternative to waiting 1 month before buying the position back, is you can just buy something that's similar but different enough. If you have an S&P 500 index fund and that has a tax loss in it, you could theoretically sell that and then perhaps buy back an index fund of a different index with different underlying companies and a slightly different composition. That's similar but different. It's kind of a gray area. The IRS, will challenge people on this from time to time, but be aware that that's an alternative. Now, as far as tax gains go, sometimes it can be a really good opportunity to go the other direction as well. Here's an example. We had a client that came on a couple of years ago who had a really highly appreciated stock position in their taxable account. And it wasn't a stock that we particularly liked. We really wanted to get it out of the portfolio, but it had appreciated so much that we were reluctant to do that because selling it would trigger taxation. We don't want to trigger taxation. So this person made good money and then they retired and their income went way down. And so the reason this is harvesting some of these gains as an opportunity now is because remember the difference between short-term capital gains and long-term capital gains. As soon as you hold an investment for 366 days or longer, long-term capital gains rates apply. The tax brackets for long-term gains are 0%, 15%, and 20%. I mentioned 0% there. If your income is below a certain threshold, the IRS actually does not tax long-term gains at all. And in this scenario, this person had, we're trying to build a really diversified and balanced portfolio for them, and we were successful in doing that. But there's this one position that was kind of a thorn in our side that we did not sell for tax reasons, right? Well, then all of a sudden, this client's income fell substantially, and we were able to harvest a tax loss earlier in the year. So between the tax loss and the rest of the room that this person had in the 0% bracket, we were able to sell about $150,000 worth of the security that we wanted out of the portfolio at zero tax impact to the client. And we'll continue to do the same thing next year, depending on their income situation. So this last opportunity has to do with harvesting capital gains. You might not even be in the 0% bracket where this can still make sense. You might be temporarily in the 15% bracket before you expect to jump up to the 20% bracket. Or you might be so concentrated and might be taking so much risk by having a large portion of your net worth in one company that you don't care about the tax consequences. It's just far too important for you to diversify. So those are all good reasons to consider this. The whole point really of today's episode is that the end of the calendar year presents an opportunity to finalize some financial tax maneuvery kind of things. And this is just a really good time of year to review it all. For me personally, my wife and I like to sit down and talk about, what vacations we want to take the next year, what's going on in the business, what's going on with our family, what our financial plan is going to look like over the next 12 months when I'm home over Thanksgiving break, because that gives me enough time to get back to the office and kind of set the calendar for the next year and then put all these things into motion as we develop our planning at the office and the business for the upcoming 1 and 3 year cycles. So that's how we do it at home. But this is just another opportunity to sit down, take advantage of opportunities and stuff that's going on right now, but also reset your vision, reset your objectives for what's going to happen come January 1st and beyond. What are you focused on? What are the things that you want to do financially and in your family over the next 12 months and beyond? And are the decisions you're making now supporting those objectives or pulling you away from them? It's just a really good opportunity to kind of reset, level set, sit down around the table with loved ones and start to figure all these things out. So those are the 5. Gifting both to charity and beneficiaries, family members, thoughtfully. Cash distributions from businesses, do that thoughtfully. Sit down with your team of professionals, make sure it's all tuned in for the year. Think about Roth conversions up to the next tax bracket, or maybe even beyond that. We've had a lot of people be aggressive in the early years and go, through the 35% bracket, perhaps, and knowing that that's going to save them a lot of taxes down the road, even though they'd otherwise be in the 22% bracket. But the whole point is reviewing where your taxes, where your cash, where everything's going to be, and then make an educated decision surrounding whether this is a good opportunity for you or not. Along the same lines, harvesting tax losses before the end of the year. Again, just in taxable accounts, they'll be in your name, jointly held with a spouse, or maybe the name of a trust. They're not going to be in your 401k or IRA or Roth IRA. All the taxes on those are either deferred or exempt, and so it doesn't make a lick of difference whether you harvest losses in there or not. And then finally, maybe harvesting tax gains, especially if your income is at a level where you're in the 0% tax bracket federally. All right. I hope this was a helpful reminder to everybody, and I will talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.